Hello and welcome to the next panel as we explore investment themes for your retirement income and answer your questions on how to help maximise your pension pot. I'm Holly Thomas, former Deputy Money Editor at The Sunday Times, and I'm delighted to be joined today by Co-Head of Investments at Amundi, Chris Morris, who manages global fixed income portfolios totalling some $4 billion and has a background combining the IMF and UK civil service. Also on the panel is NetWealth's Head of Portfolio Management, Ian Barnes. Ian leads the NetWealth investment process and holds ultimate responsibility for portfolio performance and is a CFA charter holder. Finally joining me is Citywire columnist and independent expert on investment management, Simon Evan Cook. Delighted to have you all here today. Now we've got £2.4 trillion invested in pensions. People are becoming more aware at how they invest their money is becoming more and more important. I want to talk first of all about the issues facing investors today in terms of how they achieve that retirement income. What are those issues that they face, and what's your top tip on how to address those issues? Chris?
It's difficult. That's the first thing to admit. Yields in financial markets have fallen a lot in recent years. In many ways, this is a reflection of a good process. Inflation is under control. Central banks are trusted. So yields have followed those trends down. But it does mean that for individual investors, you really have to struggle to make a good return. And added to that, of course, we have the problem now of inflation picking up. So to actually achieve an inflation-beating return is doubly challenging.
Is there something you can do?
Obviously, in my work, that's what I have to do. Yes, and what you need to do is be selective about the areas that you go into. In my case, it's fixed income, which is, of course, the most difficult area because that's government bonds, which are the lowest yielding, in many cases negative yielding government bonds. But you have to find the parts of those markets where you can still make a decent return. And there are still these pockets.
Great, thank you. Ian?
Well, I think for the main issue facing investors as they're heading into retirement is really to think about what they're saving for, what they're investing for. And of course, that differs for many different people. I think if you had to focus on one thing, it would be to consider not really just what's in your portfolio as you're approaching or at retirement, but also thinking about the types of services that you're receiving, and really what you're paying for those, whether you're doing things by yourselves or you're taking on a partner such as an advisor or a manager.
Great, thank you. Simon?
I think the big challenge, or one of the big challenges you're going to face, particularly if you're managing your own pension, is just the sheer weight of information that's out there. It's going to be bombarding you with buy Bitcoin, do this, you can now stick your house in there, or you can now buy equities, should it be bonds? There's so much stuff out there. So I guess if I have one tip, it's to do the equivalent of what's called an elimination diet when it comes to food. Now, when you do an elimination diet with food, it means that you're finding that something you're eating is causing you problems. It might be it's causing you to flare up, or it might be just making you tired. So you eliminate things from your diet. I'd say that's a very good way of looking at your finances, to look at everything you're doing and everything you've done, and to remove as much stuff as you possibly can, take it back to basics, and then build it out from there again, because you're going to get given so much stuff, so much information, and you're going to end up doing some things wrong. I think going back to basics, whatever that might be, it might be a global tracker, or it might be a mix of bonds and equities, whatever that might be, stick to that and only go out to one more level of complication once you know that you understand what it is you're being put into. If someone persuades you to buy cryptocurrencies or bitcoins, for example, you don't know what that is, just don't buy them.
That's really interesting. Thank you. And you've touched on the next topic I want to broaden out, which is the asset mix of a portfolio. You mentioned several different assets there. I think, what do investors need to think about when they're choosing assets? Ian, do you want to take this one?
Well, I think you've got to think about, I guess, each individual asset and its on its own terms, but also the interaction of different assets and as they work together. ideally, you want to have a portfolio that mixes different asset classes that respond differently to changing environments. And the tricky thing is that interaction between different asset classes changes through time. So it's not good enough just to set things in place and then forget about it. You've got to be there and, of course, maintain an overall portfolio mix that's in the right sort of risk space for your objectives, but to monitor it through time and make changes if and when they're needed.
So the tried and tested 60-40 rule then, where do you stand with that? It sounds like that's not ideal.
Well, people have been calling for the death of the 60-40 portfolio for a very long time, and that might be the case in the future. As Chris said, with interest rates where they are at the moment, the returns that you're going to get on some of those safe assets that were meant to sort of protect you within that portfolio are not going to be as exciting as they were in the past, and especially on a risk-adjusted basis. We think that there's still a role to play in fixed income assets, and in my view, a lot of the dialogue that's out there in the market at the moment suggests that market positioning is really quite one-sided in terms of inflation and what's to come. So we think there's still a role for some of those assets to be in portfolios.
Okay, that's great. Chris, would you like to fly the flag for bonds?
Yeah, maybe I can add to that. I mean, yes, there are lots of things not to like about bonds. They are negative yielding in many cases now, or very low yielding, but you don't buy them for that. You buy them for the things that equities can't give you: the stability, the reliable yield that you get. And in the case of bonds, they have a curve. And what bond investors do, we roll down the curve. So your 4-year bond becomes a 3-year bond. And that's hugely valuable. So long as yield curves have a shape, you can make positive returns in fixed income, even low yielding fixed income.
Simon, where do you stand on this?
Well, the 60-40, so obviously the classic split there is the 60 is equities, the 40 is bonds. I'm going to upset Chris a little bit here because I wouldn't personally, and I don't personally put any money in the bit that's the 40, the bonds. Whenever I'm talking to friends, family, or anyone about investing, I always look at what I'm personally doing as the starting spot. And to be honest, there's not a single penny of my own money that is in a bond anywhere. So where I have got investment assets, it's in equities or funds that hold equities, so that's where my money is. But what people have also got to think about is it's not just necessarily your pension pot. You've got to think about the entire picture of your own wealth. What does that consist of? So people quite often fixate on a very small amount of their entire pot, but that pot includes your house, it includes whatever money you've got tucked away for a rainy day in case of issues that you need to go and spend, or that you're saving for different things. So you really do need to look at everything. So the 60-40 debate in that, I think it gets lost a little bit. But when I look at my own personal mix, that bit that's the 40, which is bonds, I don't have anything invested in that personally. But
bear in mind, at the moment, globally, there's $300 trillion worth of bonds out there. 300 trillion. So somebody's buying it. And the answer is your pension, the pension that you have with a pension fund might well be invested in it. Certainly your insurance company is being forced to invest in bonds. Many public sector organizations still find a lot that attracts them in a bond portfolio. And even on a German government bond being issued at minus 60 basis points for 10 years. So that's locking in a loss of 6 cents on the dollar over 10 years, which will probably then be another 20 cents due to inflation. Those bond issues are oversubscribed 3 and 4 times routinely. And I think that brings me on to why I'm self-invested in a personal pension, because I don't want to be in one of those companies that feels forced to buy assets because of the size they are. So you do, Chris is making a really good point. You need to look at the entire mix of the assets that you're buying, and if you are buying a solution, you need to look at what's in that, and are they able to do something? Is it a little bit off the peg, or are you dealing with someone who can actually make it a little bit more bespoke and can actually
avoid these big areas that might cause you issues over coming years. They may not, but it's all in the mix of things you've got to think about.
And how does an individual decide what the right mix is then, if you're self-invested, as you say? How does one make that decision?
Well, specifically for retirement planning,
Yeah.
we think that's a really fascinating areas that, even if investors are at or approaching retirement age, it's best to prepare to be invested for an extended period of time. I think it's something like for a current cohort of 67-year-olds, 1 in 4 is meant to reach the age of 94, or 1 in 10 meant to reach the age of 98. So you've got to prepare to be ready for a very long, happy retirement in case that happens. And sometimes, when you're thinking about risk within a portfolio like that, the risky part of the equation is to be underinvested in assets that can sustain you for the long term. And that's something that we think about quite carefully, even though we're investing in very much at the liquid end of the multi-asset spectrum. Because I loved your point about trying to take in the whole realm of someone's investments, and quite often we find that people are very happy. They've got their exposure to property in one place or an investment in a friend's company somewhere else. They want us to look after just the core part of their portfolio on a very liquid basis. And when you're trying to bring in some assets out of that illiquid space into a more liquid environment, that's where the challenges kick in.
Absolutely. And I would say, again, take it back to my elimination dart. I'd start with the simplest thing you can find. Now, the simplest thing you can find is cash, and maybe we'll come on to this later, but cash, to me, isn't a great investment. You take it and compare it back to 15 years ago when you were being paid 5% on your bank account when inflation was up maybe 2%. You could do nothing and sit in cash and you were still becoming more wealthy in real terms. That isn't happening today. So if you start with the basics of being cash, you're potentially becoming poorer as inflation eats away at it. So you've got to then look at the next level of risk. What are you comfortable with? Now, that certainly used to be bonds, but we've discussed that a little bit already in the case of whether that has gone already the way of cash. The next one out, again, is equities. I think, basic large cap equities people feel comfortable with. Maybe that's the starting point today, whereas I think 15 years ago, maybe it was cash.
Can I just echo something that Ian said? I very much agree that you want to be confident that your money is going to last as long as you are. But bear in mind, people, when they retire, they frequently underestimate how long they will live, especially women. Women underestimate how long they will live. So a 65-year-old will maybe see 20 more years. But there's a bizarre behavioural aspect to this. When that person gets to 80, they think they're going to live forever. People then overestimate their life expectancy once they're past, say, 75.
That's really interesting, and brings me nicely onto our next sort of topic, which is risk, which, Simon, you've just mentioned here, and Chris quite rightly. Depending on how long you're going to live, you want to measure the risk. I think a crucial element of your portfolio is to take the right amount of risk. Presumably that changes throughout your lifetime. Chris, I think, Ian, I think you've already mentioned that. How can investors find the right level of risk for them at the right time? Simon?
Well, you're absolutely right. You do need to think about that. And as I've mentioned, risk has changed a little bit. There was, like I say, 15 years ago, you could do nothing, and that wasn't a risk. Now it is a risk because inflation is going to eat away at that. So that is going to make it harder for the more cautious investor. But it is a really, really important point because suddenly that means people are going to need to go out into equities. And that is a different emotional ride. You are going to be put through the ringer. There are going to be events like the pandemic we saw 18 months ago when you saw markets lurch down. But you almost do need to be in assets like that if you don't want to see your wealth being eaten away. But classically as well, it does depend on age. It does depend on how long you've got to invest. I've had so many people ask me over the last 3-4 years, I want to invest in something, but I might want my money back in a year's time. And you simply can't go into equities if you've only got a year to invest because there's nothing I can tell you to say that equities won't go through what they went through 18 months ago or in 2008 again at the point when you need that money. So it is so important to understand your time frame and your own appetite for risk as well.
Ian, how do you think one can construct a portfolio that has the right risk level for you?
Well, I think, again, it comes back to, people need to think about, what their overall objective for what they're saving for is. So there isn't, you need to think about the ability to take risk, but also willingness. And people have, different levels of tolerance. I think from our point of view, we try and provide a few different examples, try and stress test portfolios, offer out some different scenarios so that people could see what a portfolio will do in what might be seemingly unlikely events. But also what we try and do is embed a level of conservatism within our projections about what asset classes might do. So trying to just make sure that people are prepared for eventualities that might come through.
Chris?
Risk is unavoidable, and governments have decided that we households are well placed to bear risk, oddly enough. The whole trend over the last 30 or 40 years has been of pushing risk out of governments and onto households. So we've gone from student grants to student loans. We've gone from defined benefit to defined contribution pensions. We've got the welfare benefits that you can expect in old age have shrunk considerably, especially in real terms. So risk is with you. You've got to deal with it. And so you're going to have to lay off some of that risk into the markets.
What sort of tools are out there to help private investors, match? There's lots of talk about match your attitude to risk to your investments. How do you practically do that? Is there a way that investors can help themselves in that way?
Well, I think that there are plenty of tools that are available, and again, you're sort of straying into the area of there being too much information at your fingertips, and it's trying to sort of curate all of that into a sensible framework. We've got some tools that clients find useful in terms of planning for retirement, but again, I think it comes down to thinking about what the goals are and how, say, one pot of money is going to interact with the rest of your balance sheet and other sources of income, and test for different scenarios that to find where you're comfortable with.
And what are the sort of life events that we've talked about, how risk changes throughout your life, and even when you retire, you could be retired for a really long time still, so that's not necessarily the time to turn down the dial. But what are the sort of life events that one might choose to adjust risk when saving in a pension?
Well, I guess it takes all sorts of different forms. I mean, a lot of people talk about, marriage, family planning, divorce, and the point of retirement. But many people are saving, constructing their pension in for something that they might be in a fortunate position to pass on to younger generations. And I think the most important thing that any of us can do is have that open conversations with our loved ones and the ones that we hope to benefit from some of the savings that we've built up, hopefully, through time.
Yeah.
I would add one critical point that is often neglected in my view, and that's the importance of the age of 75. Mm-hmm. When you become 75, that day of your 71st birthday, the tax treatment of your pension changes radically. You probably dealt with this in earlier sessions today. But you can't then give on what remains of your pension pot to your children free of tax. It's going to be taxed. So you need to think through how you're going to deal with your estate up to the age of 75 and then after 75. And bear in mind, 70 is the new 75, because if you're going to do gifts out of income, then you need to start early on, bearing in mind that they will be potentially exempt transfers until 7 years has passed.
There's probably a whole session to be done on tax planning, isn't there? I wanted to talk a little bit about inflation, which, Simon, before we sat down today, you said was probably the main reason investment managers are losing sleep at the moment.
Yes.
What is your outlook for inflation, and what can investors do about it?
Well, I very aggressively have no outlook for inflation because I don't know what's going to happen. I'm not brave enough to say I think inflation is going to happen or that deflation is going to happen. So, and the very good reason for that is, if you read a Sunday paper or you read The Economist or whatever, you will find someone putting an argument in place, and I can read that argument and see that it says inflation is coming, and I can think, yes, based on everything you've said, it feels like it is. I can then turn that page and read the exact opposite argument of someone saying that deflation is coming or disinflation is coming, and I think, yes, that's going to happen too. So, but there are two extreme events, and the truth is that no one really knows what is going to happen. Now, why that matters today is because what you've seen for the last 10 years, we haven't seen outright deflation, but we've seen something called disinflation, which is effectively slowing. Inflation has been falling gradually. You've seen some growth, but it's not been runaway growth. Now, a certain type of investment will do very well in those conditions. So bonds love that type of condition. And within equities, there are certain equities which like that, most obviously growth equities. They love all of that. But what they hate is inflation. So if you suddenly have the next 10 years where you see inflation, specifically inflation coming from faster economic growth, they hate that. And so actually, if you've based your portfolio on what has done well for the last 10 years, there's a very real risk that actually you'll be in exactly the wrong stuff should we see inflation come back. So I'm not prepared to say it's one or the other. So I'm making sure I'm balanced in a kind of best of both, almost like placing an each-way bet on a horse, because I don't know which one of those two horses is going to win. So it's so important to think about. And for fund managers, you're right, they're worrying about their careers hugely at the moment, because if they back the inflation horse and the disinflation horse wins, then they're probably going to be out of a job very quickly.
Thank you. Ian, do you dare make a...
I think that's absolutely right. I mean, my colleague Jerry Lyons has posited the question as whether inflation is going to pass through the economy quite quickly, whether it's going to persist for a period of time or become permanently entrenched. And that's the thing that markets are wrestling with, not only in terms of the direct impact of what inflation could or couldn't do to their assets, but also the reaction function of the central bankers that are setting monetary policy. And you know, this generation of central bankers haven't really had to fight this battle. A lot of the time they've been trying to generate enough growth and enough inflation to get things up off the ground. So you can see in recent weeks how the challenge of addressing this problem has been coming to a head, because the communication on what is happening, or what their expectations are, what the markets are sort of trying to price in, is really difficult. So I fully agree that the best thing to do is try and get some things into your portfolios that respond in a different way to different environments. So commodities might be something that do particularly well if there is a growth or inflationary surprise, whereas some of the assets like corporate bonds or high yield have done very well from this anemic level of growth that we've had over the past 10 years. That could change, but it could be another point in time where we have to see what those disinflationary forces, how they can respond, if they can reassert themselves once the immediacy of the COVID-19 sort of policy response has sort of faded away a little bit. But it's going to be fascinating.
It's being a little bit grown up, basically. It's saying that I'm not going to go for the number one result for the next 10 years, because that'll either be the completely disinflationary portfolio or it'll be the inflationary portfolio. It's saying what I don't want to be doing is being ruined by either of those. So I'm quite happy to take the middle path, which won't be the best, but you really don't want to be the worst in either scenario.
So this goes back to your asset mix and your risk. Chris, do you have an outlook?
Well, I'm a macroeconomist, so I'm paid to have an outlook on inflation. If I don't have an outlook, I'm not doing my job. Yes, so it's really difficult to tell at the moment, and the financial world is completely torn in two by team transitory, led by the central banks, in particular the Fed, which say this is going to, and by the ECB, this is going to pass. Yes, we're seeing a little bit of it at the moment, largely due to base effects, due to COVID, bottlenecks, but this will pass and we'll get back down to a more decent level in the future, a more familiar level. And there are others who said, no, there are second round effects building in economies. I don't think it's really necessary to make a judgment on that, but you better realize that the world has changed. The world is not going to be like it was 2 years ago again. We've all got very complacent in those previous 20, 30 years. We thought central banks are so credible, they're just going to keep inflation at or slightly below 2%. Now we can see that it can go to 4 or 5%. Bear in mind, this is not a bad thing. I know it's awkward, it's painful, especially for people on fixed incomes, it's painful, but economies need inflation. That's how that inflation is the lubricant that gets resources reallocated from failing sectors to growing sectors. So the problem is in economies recently, we haven't had enough inflation. And now we're finally getting it, but we won't forget that. And even when this peak has gone out and come down again, we'll probably be higher at the end of it than we were at the beginning.
Thank you, Chris. That's fascinating. So awkward and painful. That's what we've learned.
But good.
Wonderful. Thank you. I want to move on to talk about greening your pension, which is, of course, this lovely phrase we have to describe switching your pension investments to backing companies that are driving positive change to make the world a better place, whether that be environmentally, socially, or through governance. It's certainly a topic that's been discussed at length at COP26. Is it an effective strategy for investing for retirement? And how do you start going about it? Simon, do you want to start?
Yes, it absolutely is. It's certainly, if you look back over the last 5, 6, 7, 8 years, you actually made some really good returns from investing in what qualify as being considered in a lot of cases sustainable equities, or ESG. That's one of the acronyms that's used quite a lot, friendly equities. So there's evidence to suggest that it has worked well. You always have to be a little bit wary of if the prices of the equities of these companies have gone up a lot, there's a risk that they might go down a lot as well. So you do need to be wary of that. But there's more than one way to do this. So what we're talking about there is specifically investing in the best companies today, the ones that are not the sinners. But actually one perfectly viable strategy, particularly within funds or if you're picking your own equities, is to actually engage with the companies that maybe aren't the top companies, that aren't today's saints, the sinners, if you like, but to actually get them to change their behaviour. And that's certainly in my world, which is typically working with active fund managers and buying fund managers who are engaging with companies. That's a really good thing for the environment or for society, because if you're turning a sinner into a saint, clearly that's got benefits. But the other benefit is actually a financial one to you as a holder, because those companies at the moment, because they're seen as sinners, the prices are quite low. So actually there's a potential there. Not only are you doing some good for the environment and society, you actually might get the share price of them to rise quite a bit as well. So you're seeing strategies coming out which are doing that a little bit more. But obviously it then starts to get difficult to judge whether they're actually sustainable, because they're not buying companies that are sustainable today. They're hoping that they will be tomorrow.
Yeah. Ian, what's your view on going green?
Yeah, so we think it is possible to try and align your concerns in this area with your financial objectives. We've been quite cautious here, just as we're trying to understand, what ESG means to different people, and trying to understand, what our clients expect of us, and seeing how that interacts with market movements and also regulatory change. But we think that we found a way that you can manage this in a sensible way that aligns with our sort of core objectives of managing money in a very efficient, sort of low fee way as well. We think with pensions it can be quite tricky, just because you're talking about a really long horizon, and we think about how much has changed even the past few years with regards to people's thoughts on the climate, etc. I think that it's something that you're going to have to acknowledge is going to introduce another sort of dimension of risk, both the way that the market thinks about companies that are doing good things or perceived to be bad things, and it's just another metric that you need to work with. But I think I read $1.7 trillion is invested in an economic, a climate sort of sensitive way, and that demand is not going to go anywhere. So the finance industry is going to continue to come up with as many solutions as possible to reassure people that they can satisfy their demand in that area.
And do you think investors should be rushing to switch their entire pension into sort of green, if you like, which is the phrase used, or is it a case of, again, a gentle mix, or the right mix for you?
I think it's the right mix for you. It's the latter. It's how much do you want? I mean, there's a different spectrum as well of different types of investments. There's impact, which is actually investing in companies that are doing something positive, and then you can go to the other end, which is just trying to avoid companies that are doing something bad, and so you can exclude companies that you don't like, be that tobacco or oil companies or arms manufacturers. So there is a spectrum out there. What you've got to decide is what's the right level for you, and then can you find something that fits and does that for you. So there is a bit of work to be done, but again, it completely comes back to the individual, how much they care, how much they want to change, how much they just want to avoid doing bad, or how much they want to really have a positive impact.
Yeah. There's also, just on that, there's also the opportunity of again, direct impact. So within the pension structure, people can, of course, leave percentage of their assets to a charity of choice, and so they can certainly direct, they can direct their pension in whatever way they want, which I think is going to be a great thing for people.
Really interesting. Yeah. Chris, do you have a view on greening your pension?
Very much so, and I agree. It's a wide spectrum. That 1.7 trillion goes from people who just want a slight tilt in a green direction to those who are prepared to say, no, I'm fully prepared to accept inferior financial returns in order to secure some social returns. And you have to choose where you are. And there are products at each point across that spectrum. So it will require a lot of soul searching by each individual investor, thinking not only for themselves, but also what they're going to say to their kids or their grandkids as to how they invested their inheritance.
Such an interesting topic, isn't it? I am going to ask you some questions though. We've had some questions in from the audience. I'm going to ask this first one to Simon, actually, because you were talking very much about back to basics investing when we started this session. Gillian Ashworth wants to know, what is the best way of starting out and becoming involved with investing for one's retirement as a complete beginner? So if you are just right at the outset, where do you start?
It's very, very tricky, and I'd say while you're learning, it might be good to get advice with whatever your investments are to start with. If I had one tip there, it's make sure that whoever's advising you is investing their money the same way as you. But once you've got that, you can look at how they're doing it and learning. But if you want a very specific piece of advice, I've just finished reading a book called The Psychology of Money by a guy called Morgan Housel. He has a slightly different approach to how I'd invest my money, but the whole thing made perfect sense. So maybe that's it, a very specific tip. Start with that book and then work out from there.
Brilliant, thank you. And this one actually, back on the topic of greening your pension, maybe for Chris, Hannah Kingerly asks, should investment managers be expected to put a focus on sustainability and green bonds?
Yes, we are expected, and it's in our interest to do so, and we want to make sure that we're there for whatever particular flavour of green our clients require. And we've seen that there have been these massive inflows into our ESG aware products. That's where the main flow over the last year has been. So yes, personally, we naturally do it. When I look at buying the bonds of a corporation, in addition to the balance sheet, the management, the profit and loss account, I will definitely look at the analysis that our own ESG analysts have done to see whether it is a company which maybe is an ESG improver, as Ian says. Yes, it's definitely part of our analysis.
Brilliant, thank you. And the last question comes from Alvaro Rodriguez, who asks, what is the best strategy in the long run, shares, ETFs or bonds? And anyone can answer this. Who wants this one?
Well, I don't know. I think an ETF is an asset a structure that can help you to invest into a bunch of different underlying securities. And so I think just understanding really what's going to move the performance of your portfolio is the most important thing. Make sure you've got your tax structure in place. We'd argue make sure you're doing it efficiently, you know what you're paying, and then helping to understand how that portfolio as a whole might behave in a variety of different environments is the most important thing.
Brilliant.
Yeah, I'd add to that. I mean, there's another acronym. You probably had enough acronyms today, but there's another one floating around called TINA, T-I-N-A, and that is there is no alternative. And it's one currently I agree with, and the no alternative to shares, to equities currently, I think is certainly for people looking at their pension, or be it whether you're looking at generating an income or generating a gain. It's all about shares as far as I'm concerned. There's not many other assets I'd really consider at the current time.
Fantastic, thank you. Well, thank you to Chris, Ian and Simon for that fascinating discussion, and thank you to you at home for listening and submitting all your questions. The NetWealth team are now available online for any further questions you may have. Thank you for joining this session.